What's going on, everybody? Welcome back to Trajecta Talks. I'm your host, Alex Savanovic. We've spent a lot of time recently in the theoretical deep end talking about the psychological hurdles of trading, the complex structures of private finance. Today, we're coming back to the charts. Specifically, we're going to talk about the language of technical analysis. So, if you spend any time looking at stock charts, crypto charts, or even Forex, you will constantly hear references to technical indicators like the RSI, moving averages, all sorts of things. These tools form the essential vocabulary of trading, providing quantifiable visual signals based on price action and volume. So, a quick note on scheduling: we are not including our usual market update this week as we had to record this episode much earlier than anticipated to accommodate my schedule. We'll be right back on track, I think, in 2 weeks, but for now, let's jump straight into the technical breakdown. And I just want to give a quick note on some of these tools. While I personally rely heavily on fundamental analysis, liquidity models, and proprietary indicators in my own work and do not necessarily use all or any of these public indicators, it is absolutely critical for any serious financial professional to understand how these five core public indicators work. They influence the decisions of millions of traders and therefore they influence the market momentum. And in today's market, where retail volume dictates a lot of price action, it might be worthwhile to understand some of these things. So, like I said, understanding them is understanding the collective market psychology in a way. Today, we'll break down the mechanics and utility of five essential technical indicators. Let's decode the dashboard. We'll start with the most basic and widely used tool for determining the direction and strength of a market: the moving average, or MA. MAs are the foundational filters used to separate true market direction from random short-term price noise. So a moving average is a line that simply represents the average closing price of a security over a specific period of time. Its primary purpose is to smooth out short-term price fluctuations, the noise, and highlight the underlying trend, giving the trader a clearer sense of direction. The two most common types are the simple moving average and the exponential moving average. So, the simple moving average, or abbreviated as SMA, calculates the average price over the chosen number of days. For example, you can have a 50-day, 200-day, 100-day moving average, simple moving average. Since each day holds equal weight, the simple moving average creates a smoother line that is slower to react to sudden price spikes or drops. It's often preferred for identifying longer term structural trends. So the EMA, or the exponential moving average, this is a more complex calculation that gives greater weight to the most recent price data. This exponential formula makes the EMA more responsive and quicker to react to sharp trend changes or reversals, which traders use for faster trend confirmation, especially in volatile markets. You'll often see traders use 10-day and 20-day EMAs for short-term trading signals. So the moving averages act like a waterline, sort of. If the price is consistently trading above the moving average, the trend is generally considered bullish. Conversely, if the price is consistently below the moving average, the trend is considered bearish. The angle of the moving average itself, steeply rising or gradually leveling off, indicates the strength of that trend. And now, again, none of this is advice. These are just things I've heard the moving average is being used for. You have things like crossovers. Traders use pairs of moving averages, often one short term, like a 50-day, and one longer term, like a 200-day, to generate major signals. When the shorter term moving average crosses above the longer term moving average, it's called a golden cross. Again, this is just what I've read. This is not something I used before. A classic, it is a well-known, though classic, powerful bullish signal, often seen as confirming a long-term shift upward. The reverse, the short-term crossing below the long-term, is a bearish signal that often predicts a long-term downturn. Moving averages often act as a dynamic support, a price floor that buying interest defends, or resistance is a price ceiling that selling interest defends. So, a successful test of the 200-day moving average is often seen as a key psychological battleground for bulls and bears. So, moving beyond direction, momentum indicators measure the speed and magnitude of price changes, helping traders determine if a move is strong and sustainable or if the asset is becoming emotionally exhausted and ready to reverse. The Relative Strength Index, or the RSI, is a classic momentum oscillator developed by J. Wells Wilder Jr. Jr., its primary function is to measure the speed and change of price movements, providing a quantifiable gauge of whether an asset is being overbought or oversold. The RSI is calculated based on the ratio of average upward price changes to average downward price changes over a specific period, typically 14 trading days. The resulting value is plotted on a scale that runs from 0 to 100. Looking at this scale, the most common extreme levels are 70 and 30. When the RSI rises above 70, the asset is generally considered overbought, meaning the price rise has been too fast and the asset is trading at an unsustainable high valuation, suggesting the rally may be running out of steam and a pullback or correction is possible. When the RSI drops below 30, the asset is considered oversold, suggesting the selling pressure has been exhausted and a rebound may be imminent. So this is where context becomes really important. It's vital to note that in a very strong, sustained trend, a runaway bull or bear market, the RSI can remain above 70 or below 30 for an extended period of time. Traders learn to use the indicator in context with the overall trend rather than treating the 70-30 levels as automatic buy-sell signals. That would not be smart in itself. So let's talk about divergence. This is a more advanced signal and often considered far more reliable than the raw overbought or oversold readings. A bearish divergence occurs when the price of the stock hits a new high, but the RSI fails to hit a corresponding new high. This is like a car hitting top speed but running out of gas. It suggests the momentum behind the price move is weakening and a reversal is potentially likely. A bullish divergence is the reverse. So price hits a new low, but the RSI hits a higher low, signaling hidden underlying buying pressure. Moving average convergence divergence, or the MACD, is another powerful momentum indicator developed by Gerald Appel. It shows the relationship between two moving averages of a security's price and is designed to reveal changes in the strength, direction, momentum, and duration of a trend. The MACD is composed of three components, all plotted below the main price chart. There's the MACD line. This is the fast line calculated by subtracting the 26-period exponential moving average from the 12-period EMA. This line measures the short-term momentum. There's the signal line. This is the slower line calculated as a 9-period EMA of the MACD line itself. It acts as the trigger for trading signals. Then there's a histogram, the visual difference between the MACD line and the signal line. So I know that was a lot of jargon, probably very confusing. How are these things used? So the most fundamental signal is when the MACD line crosses the signal line. When the MACD line crosses above the signal line, it's a bullish signal typically. Momentum is accelerating upward and a buying opportunity is suggested. When it crosses below, it's a bearish signal. The zero line is the center line. When the entire MACD line crosses above the zero line, it confirms that the short-term momentum is now greater than the long-term momentum, typically reinforcing a major bullish trend change. The histogram visually represents the strength of the momentum. When the histogram bars grow taller, moving rapidly away from the zero line, it indicates increasing strength in the current price move. When the bars shrink, it indicates that momentum is slowing, even if the price is still moving in that direction. There are also volatility and volume indicators. These indicators provide crucial context to price action. Volatility tells you how much risk is present in the market, and volume tells you how committed the market is to the current price move. So Bollinger Bands were developed by John Bollinger and measure the volatility of a market. Unlike the MACD or RSI, which are fixed below the main price chart, Bollinger Bands are plotted directly over the price, creating a channel or envelope around the price action. So these bands consist of three lines. The middle band is a simple 20-period simple moving average. The upper band is two standard deviations above the simple moving average that you selected for the middle band, and the lower band is two standard deviations below the SMA, whatever you selected. So the standard deviation mathematically measures how far price is deviated from its average, quantifying volatility. So the primary use is measuring volatility, like we said. When the bands are wide, it indicates high market volatility. When the bands tighten dramatically, often called a squeeze, it signals that volatility is contracting to an extreme degree and a significant price move, a breakout, may be imminent. Prices tend to revert to the middle band, or the SMA. When the price touches or breaks through the upper or lower band, it suggests the price move may be temporary or overextended. Price movements outside the bands is statistically rare, only about 5% of the time, since two standard deviations covers 95% of data and often signals strong, possibly unsustainable momentum. Now, I do want to put an asterisk there. If you do get a move outside of the bands, and like we said, that covers 95% of the potential moves, that might actually be a sign that there is a very big buyer or very big seller in a stock. So maybe it's not unsustainable. And a lot of the times you'll see in this tape, those moves aren't the unsustainable ones, and you shouldn't be selling that breakout of the band. You maybe should be buying the breakout of the band. I'm not giving you any advice or any tips, but it's just something to think about. So let's talk about volume. While volume isn't an indicator in the same way that the others are, it is arguably the most crucial contextual piece of information on a chart. Volume is simply the total number of shares or contracts traded over a specific period. It measures commitment and conviction. A volume is displayed as vertical bars below the price chart. It is analyzed not for its direction, but for its magnitude relative to the price movement. Specifically, traders compare the current volume to the average volume over the past few periods. So typically, volume would confirm the strength and reliability of a price trend. If a stock breaks out to a new high on really high volume, it confirms or potentially would confirm that many traders are committed to the move, making the trend more reliable. High volume validates the price action, suggesting institutional money is participating. Something that we always like to say is that volume leads price. If you see crazy volume in a name, along with an interesting move, volume leads price. Just remember that. If a stock breaks out to a new high on low volume, it suggests that the move lacks broad conviction, indicating only a few people are participating and may quickly fail or reverse. This is often called a fake out move. Extremely high volume at the end of a long trend, either up or down, can often signal exhaustion, suggesting a mass of traders has piled in right before a reversal, signaling a potential climax in the trend. This is often the point where retail traders enter just before the trend changes direction. So in conclusion today, guys, understanding the language of the chart, we've decoded 5 of the most popular tools in the technical analyst toolkit: the moving average for trend, the RSI and MACD for momentum, Bollinger Bands for volatility, and volume for confirmation. As I mentioned at the beginning of the episode, while these may not be the primary tools used in a quantitative hedge fund, they are the foundation upon which much of the market operates. Understanding these signals is essential because millions of other traders are watching these exact lines, and their collective actions drive price momentum. So, although you might not use them, and I might not use them for getting myself in and out of trades, they're good to understand. Remember, technical indicators are tools for measuring probability and momentum. They are not crystal balls by any means. The key is finding a handful of indicators that resonate with your strategy and learning to use them with the absolute discipline we discussed in our Mark Douglas episode. Above all else, no matter how many technical indicators you know, discipline is always going to trump everything else. So that wraps up our essential lesson on technical indicators. I hope this discussion has equipped you with the ability to look at any chart and immediately understand the story those lines are telling. To stay connected and continue your learning journey, be sure to follow us and our sponsor, Trajecta University. You can find us on Instagram, TikTok, LinkedIn, and Facebook by searching for Trajecta University. Also, check out our YouTube channel at Trajecta_talks, where you can watch the episode and find a ton of other great content. All the links are in the show notes down below just for you. So join me next time as we continue our conversation about building your financial future. Until then, keep learning, keep investing in yourself, and keep building for your future. I hope you have a fantastic Friday. Take care, folks. I'm not sure that I'm going to see you next week, but definitely the week after. If I don't see you, have a great 2 weeks off, and I'll catch you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.